Hopefully everybody did well on the exam. I would love nothing better than to give out all A's. So hang in there. Tonight we're going to do something a little bit different in the webinar. Since we've got two examples that I've just emailed you, we're going to be going through those two examples, and I will also be working at tying up the pieces so you can see how they relate. And we're recording this, so this webinar will probably be about the same level of interesting on the repeat as it is on the initial watching. So I am recording it, and I'll put it out on YouTube and available through Web Campus first thing tomorrow morning. So to get things started here a little bit, let's turn off the webcam and just go to the screen here. On the screen is a sample structure. I'm not going to distribute this because it's pretty simple. U.S. parent owns a U.S. subsidiary. The parent and the sub file a consolidated return. So we've got a consolidated return. Well, we've got a consolidated return including these people. The foreign subsidiary is not in the consolidated return, which means we have not checked the box on it. So we'll be talking about how we do a few things in the way of 861. We'll go over both of the examples that I've sent out, and we will talk about putting these pieces of the course so far together. So let's start with that. The key pieces of the course, and I'm going to just start a new slide here simply so I can do this for you. The key pieces of the course are, oops, let's try this again. Sorry about this. The key pieces of the course are the foreign tax credit, source of income rules, and the 861 rules. Now these are not everything. They are simply what we have discussed so far, and there will be more. And the source rules feed the foreign tax credit rules. The foreign tax credit rules feed 860. Well, let's try this again. Foreign tax credit feeds 861, and 861 feeds the foreign tax credit. So we've got a little bit of interaction in the rules here, and the 861 module is where we start seeing that interaction. What I'd like to do mostly tonight is go over a little bit of the basics again of 861, and then start discussing how we allocate and apportion expenses. We'll start with that burden rate example that I sent you. The number one thing we have to consider in allocating and apportioning expenses, in other words, in associating deductions with particular income, is what does the deduction factually relate to? What did we try to do by spending that money? What was our goal? What activity was supported by that deduction? This factual relationship is really the key to most of allocation and apportionment. A lot of the courses you may see in seminars or other places will focus heavily on the mechanical rules that we're going to be talking about a little later in the 861 module. Not very much tonight. It'll be in next week's sessions. Part of the reason for that focus on the mechanical rules is they're quite difficult. But the problem, especially with attorneys who teach this, is that it leads you astray to think that the mechanical rules are the be-all and the end-all of 861, where the main action is this identifying factual relationships. So let's look at an example. Now, again, I sent this out to you. It's an HTML file, so it will open in a browser. And I'll go through the facts really quickly. Be a CPA, sounds like a CPA firm, manufactures widgets, and as everybody knows, only accountants make widgets. Each accountant works on a lot of widgets at once. The shop is organized in teams of 8 to 12 with an admin and a boss within each team. Be a CPA also has an HR department, an IT department. Everybody has space that they use, and there's all the usual stuff connected with running a business. So if we want to determine what expenses relate to what income, then how do we go about it? Well, the first step is we need to look at those expenses that relate to other expenses and allocate those. Now, one of the key things that virtually every business encounters in terms of expenses is payroll burden, things like payroll taxes and fringe benefits. Now, the payroll department can probably give you a pretty accurate estimate of what the payroll burden percent is for any subset of the company or the whole company. That's the place to start in figuring out how do we allocate payroll tax and fringe benefits. We come up with payroll burden percentage for whatever segment of the business we're allocating to. We have to allocate space costs, rent, utilities, that sort of thing. And those probably relate to our production more than anything else. So in this example, I've decided based on the facts that we ought to allocate space costs per direct labor dollars. Now, why would I use that rather than some other measure? Well, as stated in our facts here, the partners have more space than the new staff. I'm sure all of you are quite familiar with that. So the space costs probably relate more to compensation than they do to headcount or some other factor that we've got. Certainly, they don't necessarily relate to revenues or gross income. So here we've chosen to allocate space costs effectively as an additional burden on labor dollars, but only to the production dollars. Because otherwise we'd just be allocating, reallocating. We need to allocate HR, IT, payroll, and space costs, and the payroll burden associated with those. In coming up with the payroll burden for those wages, we calculate it based on that 15% payroll burden on our total 135 of payroll costs. Then we've got some other costs that we have to go in and just analyze. So you'll notice these items with an asterisk. Those are all the things that you have to look at company records to figure out what they're doing. Bear with me a second. That's the reminder to start this call. So once we've determined what all of our space costs are, again, it looks like factually they tend to relate, all our IT and HR costs, they tend to relate more to payroll dollars. So that's how they're allocated. Now, if you'll notice here, we've got a payroll burden as a percent of wages for payroll tax and fringe benefits, a space burden as a dollar amount per dollar of wages, and an HR burden as a percentage of wage dollars. We have to go through the same process with supervision and any other overheads that we might have. Now, in my book, and that's where this example is from, you'll find it in the cost of goods sold chapter. In the book, I talk about doing these allocations as part of determining cost of goods sold. This stuff, though, relates to everything, not just cost of goods sold. If we're calculating a foreign tax credit limitation, we have to start with foreign source taxable income. And to get to foreign source taxable income, we got to allocate costs. If we're trying to compute the domestic production activities deduction, we've got to start with qualified production activities net income, which is after all these deductions are allocated. So one of the acceptable ways to allocate a lot of these expenses, these overhead expenses, is based on labor dollars, labor hours, or some other method that we've decided is worth doing because it relates to our facts. So with that, I would like to first ask if there are any questions on this sort of burden type of allocations. Okay, so absent any questions at the moment, by the way, I will distribute the complete version of that example with everything filled in by tomorrow morning. So with that, I sent out another example, and I just sent you the facts with this. And this one, again, we'll go through this. And the facts are kind of complex, not nearly as complex as you get in the real world, but they're kind of complex. So this is going to be a little tough to follow. Now, before we continue, I want to point out that this entire area, this allocation and apportionment of expenses, is almost the exclusive province of us accountants. I've worked with attorneys who were not accountants, and with one exception, and he's the guy that wrote the 861 regs back in the 80s. With one exception, they didn't understand this stuff. This is on us, the accountants. I've worked with other CPA attorneys, and if they didn't focus very much on things like cost accounting in their undergrad days, often they had trouble getting this. So this is where the course gets hard. There are some very difficult concepts in this 861 module. So let's go through some of our facts. We've got U.S. parent, U.S. sub, foreign sub, with all of their P&Ls here. I don't present the balance sheets. And then we've got some eliminations, and the eliminations can help us identify a few things. And then we've got some amounts per the 1120. Now, I'm assuming all of these things as facts here in this example. In the real world, you may be responsible for coming up with those per 1120 amounts based on books. You almost certainly have book tax differences, as we're all aware. So with that, let's start looking at what steps we need to do to get to foreign source taxable income. We'll take each step at a time, and I'm going to distribute the solution, if you will, to all of you tomorrow morning. So the first step, as we talked about in the 904 modules, is we've got to basketize income. And that means looking at what pieces are shown on here that are either 863B, general, or passive. Now we don't have any passive here because of the look-through rule. So our interest and dividends here and the gross up are all look-through because we have a 100% foreign subsidiary. And I apologize for not saying the foreign sub is in manufacturing, doesn't have any passive income. So it's all look-through and general basket. In the real world, you may find that you've got a lot of other things besides general basket going on. Now, hopefully, doing this will not make it impossible to see. But then once we've identified the particular pieces, we've also got some 863B sales. If you'll recall, that's sales of goods made in the U.S. with title passing outside the U.S. This information is something, you'll note I stated this in the facts, it's something you can get from the accounting folks, even at fairly small clients. Because all they have to do is generate a report of sales and cost of goods sold by destination, and then you have to find out what company policies are like for title passage. So this is all stuff that can be obtained, and it's pretty easy to deal with. Next, we have to apportion our indirect costs. You'll notice I've got an item here for HR, IT, everything else. And that number at the parent company level needs to be apportioned. And if you'll notice, we probably should be apportioning the subsidiary one too, which I didn't do. So let's change our results here and see what we're apportioning. And again, I'll distribute this example to you. So first step, determine the baskets of income. Second, then we start allocating and apportioning expenses and start with indirect items. Next, we have to allocate or apportion stewardship expenses. Well, generally stewardship expenses are apportioned on gross income of the subsidiaries. And where we have a consolidated return group, the consolidated group is considered to be one taxpayer. So the only subsidiary that we have is the foreign subsidiary. So all of this stewardship expenses, including the portion of overheads, gets allocated directly to foreign source general basket income. As you'll see later, that kind of hurts. Next step is we have to do something with our overall SG&A expenses other than R&D. We have G&A salaries and expenses, sales salaries and expenses, and we have to do something with these because they relate to our income. The sales salaries, I have not done it here just for laziness and minimal effect. The sales salaries tend to relate only to sales income. And the other G&A expenses tend to relate to everything. So one of our options to apportion this is based on sales. One option is based on gross income. I put a quick pencil to it, not shown here, and it worked better to do it on sales for this particular year. Can I justify switching to gross income next year? Maybe, maybe not. It's worth a shot if it works better that year. So in just adding these things up, when you have the example in hand, you'll be able to track the numbers, including look at the formulas, to see that everything is really coming from above with those burdens added in. And once I apportion everything on sales, you can see the formula up here. The result is we've got 6.2, and this shouldn't be here. Bear with me a second. We've got 5.4 of expenses apportioned to sales. And to H63B sales, and 800,000 apportioned to general basket because it's going to that interest income. Remember that interest income was all looked through in general basket. Once we've gotten SG&A out of the way, then we get to our two formulary apportionment items. Now, we've only discussed this very briefly in the introduction and in the 861 introduction. So I'm not going to go into much detail on apportioning R&D and interest expense. But again, I'll distribute those so you can kind of see how they work. And that should be highlighted. So once we, with R&D, we get to choose once every 5 years whether we're going to apportion it based on worldwide sales or 1120 gross income. If we're using the sales method, 50% of the R&D costs get allocated to wherever the R&D was incurred, in this case, in the US. And the other 50% get apportioned. But since this is worldwide sales, it's not based just on our 863B income here. It's also our 863B sales. It's also based on our foreign sales. It could potentially also include sales to third parties. I'm sorry, the licensing to third parties. We'll discuss this in nauseating depth in the R&D apportionment section. I'm going to omit the discussion for the moment of how we apportion the interest expense. And there's a super simple version of that interest expense apportionment in the example that I'll send out as an Excel spreadsheet. So once we have all of these expenses identified, let's get it where we can see it there. Okay. Once we've got our gross income and our expenses identified, then we can come up with net foreign source taxable income and see how that net foreign source taxable income relates to our total taxable income. In this example, it turns out to be about 40%. Our total U.S. tax, shown above, was 6.3, and 40% of that 6.3 is 2.5. Well, we had foreign taxes available for credit of 4 million, but our limitation is only 2.5 million. Houston, we've got a problem. So our foreign tax credit is limited to $2.5 million. Now, I want to show you one of the facts again, in case you didn't focus on it. All of this is coming through our foreign subsidiary. You might say at this point, oh, the problem is the foreign sub is in a high tax jurisdiction. No, it's not. The sub has a tax rate of only about 28%. So even though we have a low tax foreign subsidiary, and we're repatriating, in this case, a little bit more than their current income, but we've got a low tax foreign sub, and we've got a bunch of 863B sales, we still have a foreign tax credit limitation problem. And it's this problem that is the focus of an awful lot of our international tax planning. So again, I'll distribute this spreadsheet to everybody. And if you have questions, this is a good time to ask them. And we're not having a conference call tonight, but Saturday we'll have a conference call, and next Wednesday we'll have one. Those are also good times to ask questions as we get further into this 861 module. So, questions?